This is one of the greatest periods for overseas investment in Canada that we've seen in the century. And it may be unprecedented because, we have to wait for the rest of the year. But the short answer to your question is that money is pouring into Canada like we have not seen from everywhere. Stocks and bonds are the obvious beneficiaries. Canada, since Mark Carney became the Prime Minister in March of 2025, has outperformed everyone in America and also the Eurozone and everywhere in the world. The 10 largest stock markets in the world, Canada appreciated the most, more than 40%.
Like money is moving, and Canada is suddenly sitting much closer to the center of the global investment map. Foreign direct investment in Canada reached nearly 100 billion Canadian dollars last year, its highest level since 2015. At the same time, Ottawa is pushing major projects, new trade routes, and a 1.8 trillion Canadian dollars investment plan. The shift is already changing the economic picture. Bloomberg recently highlighted a major change in where global capital is moving. Investors are looking at Canada during a period of major trade and geopolitical uncertainty. Mark Carney's government is also pushing a strategy built around stronger domestic investment and less dependence on one major trading partner. That matters because the United States has long been central to Canada's economy. Canada and the US have one of the world's largest trading relationships. But Canada is now working to expand its links with other markets and attract more investment from outside North America. RBC says Canada is back on the capital radar. Its research found that foreign direct investment reached nearly 100 billion Canadian dollars last year. That was the highest level since 2015. It was also the first time in a decade that investment coming into Canada was greater than investment leaving the country. That change is important because Canada had spent much of the previous decade facing a very different capital picture. RBC says more than 1 trillion Canadian dollars of investment left Canada between 2015 and 2024. For every dollar of foreign direct investment entering Canada, about $2 exited. Now the direction is changing. RBC estimates that Canada has a 1.8 trillion Canadian dollars investment opportunity over the next 10 years. The money would be directed toward 6 major areas: oil and gas, electricity, agriculture and food processing, metals and minerals, defense, and space. These sectors are tied to exports, research, national security, and long-term economic growth. The largest part of the proposed investment is energy. RBC puts the potential requirement for oil and gas at 705 billion Canadian dollars over 10 years. Electricity follows at 670 billion Canadian dollars. Agriculture and food processing account for 205 billion Canadian dollars, while metals and minerals represent 200 billion Canadian dollars. Defense and space account for 19 billion Canadian dollars and 12 billion Canadian dollars respectively. These are not government spending figures already sitting in a bank account. They are investment estimates in RBC's growth scenario. The report describes what Canada could build if it attracts enough private, institutional, foreign, and public capital. Canada already has large pools of capital available. RBC says Canadian pension funds and asset managers together hold nearly 10 trillion US dollars. It also estimates the global capital pool at roughly 150 trillion US dollars to 200 trillion US dollars. RBC points to permitting, regulation, project delivery, and policy certainty as major issues. The report says investors can accept risk, but they are less willing to deal with unclear rules and changing frameworks. It also says Canada needs stronger incentives for businesses to take risks and invest in new projects. Canada has large oil and gas resources, but its export system has limits. RBC says pipelines are close to full capacity, and several major projects were delayed or canceled during the past decade. The report says new infrastructure could give Canadian producers more access to global markets instead of relying mainly on US buyers. Canada's natural gas industry is also expanding. The report points to strong interest from Asian and European countries seeking energy security. It says Canada's West Coast is positioned to supply those markets if export capacity permits and Indigenous partnerships move forward. RBC estimates 670 billion Canadian dollars could be invested in electricity under its larger growth scenario. Canada's power system is already built around roughly 80% non-emitting electricity, mainly hydro and nuclear. But electricity demand is expected to rise as electric vehicles, buildings, industry, and data centers require more power. RBC says demand could double by 2050. The scale of the planned expansion is large. And if you want the real story behind how Canada is still holding its ground through tariffs, wars, and hard times, hit join below to join the membership for exclusive documentaries you won't see anywhere else about Canada's progress and rise through uncertainty. Under RBC's step change scenario, Canada would build 119 gigawatts of new generation capacity and expand the electricity grid by about 240,000 kilometers. Those figures describe a potential future investment path, not projects that have already been completed. The Canadian government is also moving to attract capital directly. Its 2026 economic update announced the Canada Strong Fund, with an initial 25 billion Canadian dollars government contribution over 3 years. The fund is designed to invest alongside other investors in strategic Canadian projects and companies. The government has also announced an investment summit planned for September 2026 to bring major global investors to Canada. Ottawa says 15 major projects announced so far represent more than 125 billion Canadian dollars in capital investment and are expected to support more than 60,000 construction jobs. Those projects form part of a wider effort to increase infrastructure, energy, trade, and industrial investment. This is where the Canada-US economic story becomes more important. Canada is not simply trying to attract money. It is trying to redirect capital toward infrastructure, energy, minerals, defense, and other industries that can expand its global trade options. RBC's report describes the opportunity as a possible shift after a decade of weak business investment and major capital outflows. The numbers show why the change is getting attention. Nearly 100 billion Canadian dollars in foreign direct investment last year, more than 1 trillion Canadian dollars of investment that left Canada over the previous decade, and a potential 1.8 trillion Canadian dollars investment requirement over the next 10 years. Canada's strategy is tied directly to trade. For decades, the United States has been Canada's largest trading partner. That relationship remains extremely important, but recent tariff disputes have pushed Ottawa to look for more options. Bloomberg reported that Canada is trying to turn pressure from US tariffs into an economic opportunity by building stronger links with other countries and attracting more investment. The shift is already visible in Canada's trade policy. Ottawa has been working to expand trade with Europe and countries in the Indo-Pacific. Canada has trade agreements with major economies and groups outside the United States, including the European Union through CETA and countries covered by the Comprehensive and Progressive Agreement for Trans-Pacific Partnership. This does not mean Canada is cutting itself off from the United States. The two economies remain deeply connected. Statistics Canada reported that the United States continued to account for the majority of Canada's exports of goods and services. But the pressure to diversify has become stronger as tariffs and other trade measures create new risks for Canadian businesses. Canada also has resources that other countries need. Critical minerals are one example. The country has deposits of minerals such as nickel, lithium, cobalt, and copper. These materials are used in batteries, electronics, defense equipment, and clean energy technology. Expanding production could give Canada another way to attract foreign capital while building new export markets. The same strategy applies to energy. Canada's oil and gas producers have historically relied heavily on the US market. New export infrastructure can give Canadian producers access to customers farther away. The expansion of the Trans Mountain Pipeline has already increased Canada's ability to move crude oil to the Pacific coast, giving producers more direct access to international markets.